Forget the chart for a second. What you're watching is not a rally. It's the market losing structural integrity in real time. Shanghai at $105 is the trailer. The vault drain is the full movie. And when you connect those two, you'll see why this isn't going up. It's resetting. So here's the reality. Right now, the world is living in two prices. Shanghai physical silver, about $105. Comex paper silver, about $93. That's a gap of about $12. And I need you to understand something immediately. That's not a spread. That's a structural fracture. A $12 gap on the same metal is a market quietly admitting that price discovery is failing. Because in a normal world, that gap gets crushed within hours by arbitrage. Traders buy in the cheap market, sell in the expensive market. The difference disappears. So if it's not disappearing, what does that tell you about the availability of real metal? The only reason a $12 arbitrage stays alive is if the bridge between paper and physical is breaking. And when that bridge breaks, the screen price stops being the truth. The vault does. Here's the snapshot. Gold is still grinding. It looks like a disciplined bull market. But silver has moved into something else. Silver is now doing what it does in the danger zone of a metal cycle. It starts moving faster than the narrative can keep up. And your two key numbers are these. Comex paper, approximately $93. Shanghai physical, approximately $105. That means if you can source metal at the Western reference price and deliver it into the Eastern demand price, you've got a $12 window. Now stop and think. That is not a small inefficiency. That's an incentive big enough to move serious tonnage. $12 per ounce is not pocket change when you scale it. On 1,000 ounces, that's $12,000. On 100,000 ounces, that's $1.2 million. On 1,000,000 ounces, that's $12 million. This is why metal doesn't sit still when the gap opens. It moves, or at least it should move. And the fact that this gap is persisting tells you something is fundamentally broken in the system that's supposed to keep prices aligned globally. Some people will try to dismiss this because it's only $12. No, if you're thinking it's only $12, you're thinking like a retail trader staring at a chart. Institutions think in flows. They think in logistics. They think in inventory. The moment the gap moves from cents into double digits, it stops being about pricing. It becomes about routing. It becomes, where does the metal go? Who gets supplied? Who gets cut off? Who pays up? Who gets cash settled? And that's why the gap matters more than the headline price. Because the gap is the stress test. It reveals whether the market's plumbing actually works. And right now, the plumbing is clogged. Let me give you the clean mechanism, no fluff. Shanghai bids higher for physical delivery. The higher bid creates an arbitrage incentive. Arbitrage triggers physical sourcing in the West. Sourcing triggers vault drawdowns. Drawdowns reduce deliverable inventory. Reduced inventory increases delivery risk. Delivery risk widens premiums and encourages more grab-it-now behavior, which makes the physical market even tighter. That loop feeds itself. It's reflexive. And reflexive markets do not move politely. They gap, they spike, they squeeze. Here's an analogy that makes this crystal clear. Imagine two gas stations across the street from each other. Station A sells gas for $3. Station B sells gas for $3.75. People don't analyze it. They line up at Station A until the tanks run low. Then Station A either raises its price or runs dry. Now map that to silver. Comex paper at $93 is Station A. Shanghai physical at $105 is Station B. The $12 gap is the crowd forming. The crowd doesn't care about your chart. The crowd cares about price and availability. And when Station A starts running low, when the cheap silver isn't available in the quantities people need, they have no choice but to go to Station B and pay $105. That's when Comex prices start catching up to Shanghai. Not because sentiment changed, because availability changed. Now here's the perfect question. If it's free money, why isn't arbitrage closing the gap? This is the question that reveals what's actually broken. In a healthy market, the gap closes automatically. So why doesn't it close now? 3 reasons. First, sourcing friction. You can't arbitrage what you can't source. When metal is tight, every large purchase moves the price against you and availability disappears. You call a dealer to buy 100,000 ounces at $93. They might tell you they can get you 20,000 at $93, another 30,000 at $95, and the rest you'll have to wait 3 weeks for at whatever the market price is then. Your arbitrage just evaporated. Second, time and logistics. Even if you can source it, you've got insurance, compliance, and transport. Silver moving from New York to Shanghai takes weeks. During those weeks, prices can move against you. The gap can narrow or reverse. What looks like guaranteed profit becomes uncertain speculation. Third, policy and regulatory friction. Your ability to complete the loop can be constrained. China's export controls on silver, implemented in January, are a perfect example. Even if you can buy cheap silver in the West, getting it into Shanghai vaults may require government licenses that are difficult or impossible to obtain. Your arbitrage is blocked by policy, not economics. And when the loop is constrained, the gap persists. A persistent gap is the market admitting that physical is not as mobile as paper. And this brings us to the sentence that explains the entire era. Paper can print. Bars cannot. Comex can create contracts, 100,000 of them. But a contract is not a bar. When the gap hits double digits, people stop treating contracts like exposure and start treating them like claims. They demand delivery. And that's where fractional reserve models start sweating. A fractional reserve system only works when most participants settle in cash. But arbitrage incentives make people do the opposite. They settle in metal. They remove supply. And when enough people demand delivery at the same time, the system discovers it doesn't have the metal to satisfy all the claims it sold. Here's why the $12 gap matters psychologically. At $12, you're not just seeing a premium, you're seeing two markets. A paper reference market, Comex at $93, a physical priority market, Shanghai at $105. And when two markets exist, the question becomes, which one forces the other to move? Historically, physical eventually forces paper. Because paper can't deliver what it doesn't have, but paper can delay. The paper market's power is speed. The physical market's power is inevitability. We're watching this contest play out in real time through the $12 gap. Let's keep the math conservative. If the West simply catches up to the East, if Comex reprices from $93 to $105, what happens? That's a $12 move without any new story, just convergence, just the gap closing. That's a 13% gain from current levels based purely on price alignment, not on new demand or reduced supply. Just the market admitting that the real price is what Shanghai is paying, not what Comex is quoting. Now imagine what happens if momentum traders pile in, if shorts get squeezed, and if physical buyers keep bidding. That's how you get overshoots. That's how you don't just converge. You spike through. Markets don't glide to fair value. They overshoot it. Always. The psychology of markets ensures that once a move gets momentum, it goes too far before correcting. If 93 needs to reach 105 to close the gap, it will probably touch 115 or 120 before settling back. Now let me explain what's happening in the background that most people miss. Shanghai is not just a price. Shanghai is a message. It's telling you that in the world's largest manufacturing economy, in the region with the highest industrial silver consumption, real buyers are willing to pay $105 right now for immediate delivery. Not for a futures contract, $105 for metal you can put in a vault today. That premium exists because Chinese manufacturers cannot afford production stoppages. A solar panel factory that runs out of silver doesn't just lose a day of production, it loses customer contracts. It faces penalty clauses. The cost of not having silver far exceeds paying a $12 premium over Western paper prices. So they pay, and as long as they're willing to pay, the premium persists. This creates a one-way flow of metal. Have you noticed what's happening with silver? It's moving, and it's all going one way, from west to east. Why? Because that's where the premium is, and you need to understand that every single ounce that moves east is an ounce that's no longer available in the west. It's not coming back. It's being consumed, locked away in solar panels, electronics, and automotive parts. It's gone from the Western supply pool permanently. As Western inventories get smaller and smaller, buyers in the West are starting to face the same reality that buyers in the East have known for a while. If you need physical metal right now, you pay the premium, or you don't get the metal. Let me walk you through the actual vault data that proves this is happening. Let's start with Comex registered silver. That's the metal available for delivery against futures contracts. In early 2020, there were over 350 million ounces. Today, it's under 240 million ounces. That's a drop of over 100 million ounces in just about 5 years. So where did it all go? A lot of it went east. Some went into private vaults. Some was delivered against contracts and taken out of the exchange system entirely. But the direction is undeniable and consistent. It's going down. It's the same story over in London. The vaults of the London Bullion Market Association, the LBMA, show a similar persistent decline in their silver holdings. The metal is leaving, and it's not being replaced. New mine production can't fill the gap because it's already promised to existing industrial contracts. The vaults are draining, and the pace is picking up, especially as the price premium in Shanghai gets wider, creating an even stronger pull on whatever metal is left. Now this is where it gets really critical for understanding what happens next. Right now, we're seeing a significant price gap, let's say $12, between Shanghai and New York. In a normal market, this kind of gap should fix itself. The high prices in Shanghai should either curb demand or attract more supply. The lower prices in New York should boost demand or cut the local supply. These adjustments are supposed to bring prices back together, but they're not happening. Demand in Shanghai isn't falling, even with higher prices, because industrial consumption isn't optional for them. And supply in New York is unincreasing because there's simply no extra supply to bring to the market. The textbook economic adjustments are failing. This right here is what market failure looks like. It's not some dramatic overnight collapse. It's a persistent grinding dysfunction. Prices that should be the same are stubbornly staying apart. Arbitrage, which should be automatic, has become impossible. And the longer this dysfunction goes on, the more likely it is to resolve through a sudden violent price explosion rather than a slow, gradual adjustment. Let me explain exactly how this repricing could happen. Currently, the Comex price for silver is mostly set by paper trading. We're talking about hedge funds, algorithmic trading systems, and index funds buying and selling futures contracts. They're trading based on technical charts, momentum, and portfolio rules. These players rarely, if ever, take physical delivery of the metal. They are trading a financial instrument whose price is supposed to track physical silver, but in reality, it's driven by financial market flows that are largely disconnected from actual physical supply and demand. The Shanghai price, on the other hand, is determined by real physical transactions. Real buyers are purchasing real metal for immediate delivery. These prices directly reflect how much physical metal is available and how much industry needs it. As long as Shanghai can get metal from global markets at a reasonable price, say below $105, its price stays anchored to the global supply. But what happens if the global supply gets so tight that metal can't be sourced reliably, even at those higher prices? That's when the Shanghai price could spike dramatically. And once Shanghai spikes, Comex will have no choice but to follow, because the incentive to buy cheap in New York and sell high in Shanghai would become overwhelming. Here's the nightmare scenario that keeps exchange officials awake at night. Imagine a large industrial consumer in China needs 10 million ounces of silver immediately for production contracts they absolutely cannot delay. They bid $110 an ounce in Shanghai. No sellers. They bid $115. A little metal shows up, but not nearly enough. They bid $120. Suddenly, arbitrageurs wake up. They start buying Comex futures contracts, planning to take delivery of the cheap silver and sell it in China. But remember, Comex only has 240 million ounces of registered inventory. If multiple large buyers try to take delivery at the same time, there just isn't enough metal to go around. At that point, Comex has two choices. One, they can deliver the metal they have, draining their inventory to critically low levels and triggering delivery failures on later contracts. Or two, they can hit the emergency button, massive margin hikes, position limits, or even forcing contracts to settle in cash instead of metal. Either choice would completely destroy confidence in the futures market as a reliable way to price silver. Either choice proves that the Shanghai price was the real price all along, and Comex was just trading a fantasy. This is why that $12 gap isn't just an interesting number, it's a warning signal. It's the market screaming that the system is under extreme stress and that stress is building, not going away. Every week that this gap persists, more physical metal flows east. Every week, Western inventories shrink a little more. And every week, the risk of a chaotic, disorderly repricing gets higher. Now, let's talk about what the institutions usually do when they feel this kind of pressure building. Their playbook is pretty predictable. First, they hike margins to flush out anyone holding long positions with borrowed money. By making it more expensive to hold a futures position, they force traders to either put up more cash or sell. This creates artificial selling pressure that pushes prices down temporarily. It creates the illusion that the rally is over and normalcy is returning. Second, they orchestrate paper dumps. Large short sellers, often with a nod from the exchange or regulators, will sell a massive number of futures contracts in a very short amount of time. This creates scary red candles on the charts and panics retail traders into selling their positions. These dumps have nothing to do with fundamentals. They're psychological operations designed to shake your confidence. Third, they control the narrative. You'll hear things like, the Shanghai data is unreliable, or it's just a temporary anomaly, or it's all speculative froth. Official statements and media coverage will frame the price gap as a weird quirk, not a signal of a real physical shortage. They do this because if the story becomes about a physical shortage, buying will accelerate. And finally, if the risk of a delivery default becomes real, they change the rules. Exchanges have done it before, modifying delivery terms, imposing position limits, or changing contract specifications. These moves protect the exchange itself, but they destroy the confidence of anyone who relies on those contracts for price discovery. Here's the big tell. When you start hearing public discussions about the rulebook, the system is in trouble. Normal markets don't need emergency rule changes. Stressed markets do. So if you see Comex or the LBMA announcing procedural changes or reviewing delivery protocols, that's their admission that the current situation is not sustainable. So What should you be watching for next? First, does the Comex price start to climb toward the Shanghai price? If it does, that's an early sign that the paper markets are finally acknowledging physical reality. Second, what does the Shanghai price do? If it stays high, the premium is real and entrenched. If it goes even higher, the stress is getting worse. Third, watch dealer premiums and delivery delays. If they rise even while the Comex spot price pulls back, that's the classic sign of a paper market smash where the physical market remains tight. It tells you the paper market volatility is just noise and the physical tightness is the real signal. And finally, watch for margin requirement hikes. Exchanges don't raise margins for fun. They do it when they're worried about their own financial exposure if traders default. It's a signal of fear, not confidence. If that price gap stays open while volatility keeps rising, the next move is usually a violent one. When the normal mechanisms fail, markets resort to abnormal ones: price gaps, flash crashes, and emergency interventions. None of those are fun if you're caught on the wrong side. Let me share my personal logic here, but remember, this is not financial advice. I don't sell physical metal into a world where physical is clearing at a huge premium. If Shanghai is paying $105 while Comex is quoting 93, that tells me the physical metal is worth at least $105. Selling at the Comex price means leaving $12 on the table. That makes no sense. I also don't trust paper instruments when the rulebook is in play. When exchanges are messing with margins and delivery rules, they're admitting their system is stressed. Physical metal sits outside of that stressed system. For me, margin hikes are a fear signal from the exchange, not proof that a rally has ended. And above all, as long as Shanghai is paying a premium, the market is telling you that the price on your screen is not the whole truth. The screen shows you what futures traders are doing. The premium shows you what physical buyers are doing. And right now, the physical buyers are paying up, which means they can't get metal at the screen price. That's reality. Everything else is perception. Let me explain why this price gap between the Shanghai and Comex silver markets is different from past gaps that eventually closed. In previous episodes, premiums in Shanghai were usually because of temporary issues, like logistics problems, sudden regional demand spikes, or currency swings. Once those temporary factors were resolved, metal flowed freely again, and the prices converged. But this time is different. The current gap is driven by structural factors that aren't temporary. China's export controls are a matter of policy, not a shipping delay. The depletion of Western silver inventories is the result of years of deficits, not a temporary drain. And the acceleration of industrial demand from solar and electric vehicles is a multi-decade trend, not just a short-term spike. These structural factors mean the gap might not close through normal arbitrage at all. It could close with Comex prices, repricing much higher to catch up with Shanghai. Or the gap might just persist indefinitely as the markets fully decouple into separate regional systems. Either outcome is unprecedented in modern silver markets. Either way, it confirms we're in a new regime where the old patterns and expectations just don't apply anymore. The implications of this go way beyond silver prices. If a major commodity market can split into regional price zones that don't balance each other out, what does that say about globalization? What does it say about the assumption that commodities trade in unified global markets? And what does it say about how reliable futures markets are for discovering true prices? These are huge questions that affect the entire commodity system. But for silver specifically, the implications are crystal clear. If Comex can't maintain its authority on pricing, because the physical supply is increasingly clearing in Shanghai at different prices, then Comex becomes less relevant. Industrial consumers will stop using Comex quotes for their budgets. Mining companies will stop using it for their production plans. And investors will realize that Comex prices don't reflect the actual cost of getting your hands on the metal. The exchange loses its function. Alternatively, Comex could stay relevant by allowing its prices to rise to levels that truly reflect physical scarcity. This would mean accepting that silver is worth $100, $110, or even $120 or more, based on genuine supply and demand, not paper trading dynamics. It would mean letting the shorts face their losses as prices rise to clear the physical market. It would mean accepting that the era of cheap silver is over. So the choice Comex faces is this: maintain artificially low prices and lose relevance, or allow prices to rise and maintain relevance as a price discovery mechanism. Economic forces strongly favor the second option, because markets that lose relevance eventually lose volume, and that undermines the exchange's entire business model. But political and financial considerations might favor the first option, because large financial institutions hold massive short positions that would face enormous losses if silver reprices to $100 or higher. This tension between economic necessity and political preference is what's creating the volatility and dysfunction we're seeing right now. The market wants to clear at higher prices, but powerful interests want to prevent that from happening. The result isn't stable low prices, nor is it an orderly adjustment to higher prices. The result is price gaps, volatility, intervention, and a persistent disconnect between the paper price and the physical metal. For us as individuals, this environment requires clear thinking about what we actually own and what risks we're facing. If you hold Comex futures, you hold a claim on a system that is under a lot of stress, and that claim might get settled in cash at prices that don't reflect physical value. If you hold Shanghai contracts, you have a stronger chance of getting physical delivery, but you face different risks related to the Chinese financial and regulatory systems. But if you hold physical metal in your own possession or in allocated storage, you hold an asset that's independent of either exchange system. You have no delivery risk, no cash settlement risk, and no counterparty risk beyond your storage provider. The premium you pay for physical, that difference between the spot price and what you actually pay for a coin or bar, is your insurance against all these systemic risks. In normal times, that insurance can seem expensive and unnecessary. But in stressed times, it's the difference between having real metal and having a paper claim that might not be honored. We are transitioning from normal times to stressed times. This $12 gap is just one of many signals confirming the shift. Now, a question a lot of you are asking: could this gap reverse? Could Comex start trading at a premium to Shanghai? In theory, yes. If Western industrial demand suddenly surged while Eastern demand collapsed, or if massive new supply hit Western markets while Eastern supply was constrained, the premium could flip. But let's look at the fundamentals. Western industrial demand for silver is relatively modest compared to Asia's. Western mine production is declining, not surging. The structural factors all favor continued premiums in the East, not a reversal. The more likely scenarios are either the gap widens even further as physical metal in Shanghai becomes even scarcer, or the gap closes because Comex prices finally move higher. A reversal where Comex trades at a sustained premium to Shanghai would require fundamental changes that just are not on the horizon. So, treating this gap as a temporary anomaly that will just fix itself by converging back to Comex levels is wishful thinking. It's not supported by the current data. So, let's talk about the endgame scenarios. How does this all resolve? First possibility, Comex reprices to meet Shanghai. The paper silver price rises from $93 to $105 and beyond. Shorts are forced to cover, driving even more upward momentum. The gap closes because Western prices rise, not because Eastern prices fall. This is the most economically logical outcome because it aligns prices with physical reality. It's also the most painful for the shorts and the most profitable for the longs, which means it will be resisted until resistance becomes impossible. Second possibility, the markets fully decouple. Comex continues trading in the $90 to $100 range, but it becomes just a paper financial instrument, disconnected from physical supply. Shanghai and other physical markets trade based on the actual availability of metal at whatever price that requires. Industrial consumers and serious investors would increasingly ignore Comex and transact directly in the physical markets. Comex would become irrelevant for price discovery. Its volume would decline, and eventually, the exchange would either have to abandon silver trading or completely restructure its contracts to regain relevance. Third possibility, intervention. Governments or central banks, recognizing that a silver shortage threatens key industrial priorities like solar panel deployment and EV production, could release strategic stockpiles. They might impose price controls or mandate allocation systems. This would keep Comex prices artificially low, but it would create black markets where physical metal trades at completely different prices. It would also be a massive confirmation that the shortage is real and severe enough to warrant emergency measures. Fourth possibility, a supply shock. A major new silver discovery, a technological breakthrough in recycling, or an industrial substitution that dramatically reduces silver demand. These would eliminate the scarcity premium and allow prices to converge downward, back toward Comex levels. This is possible, but it seems unlikely given how long the industry has searched for substitutes and how mature the technology is in major applications. Of these scenarios, the first one seems the most probable. Comex repricing to meet physical reality through higher prices. The second is possible if resistance to higher prices remains so strong that Comex loses its relevance rather than adjusting. The third becomes more likely if prices rise high enough that governments start to view it as a crisis. And the fourth would require a game-changing development that we just don't see coming. Regardless of which scenario unfolds, that $12 gap is telling you that the current situation is unstable. And unstable situations don't last indefinitely. They resolve. And resolution usually happens faster and more dramatically than most people expect. The gap widened gradually over months. It could close through a repricing event that happens in days or even hours if the right catalyst triggers a rush for physical delivery. So let's end where we began. Shanghai at $105 is the smoke. Comex at $93 is the illusion of normal. The $12 gap is the evidence, and that evidence says one thing. Arbitrage is not functioning like it should, which means physical metal is not as available as the paper price suggests. Watch the gap, watch the vault data, watch the real-world premiums, because in the end, the screen can quote any price it wants. But the vault can only deliver what actually exists, and that's the real market. It's the market that's telling you, through a $12 premium, that metal is scarce, that supply is tight, and that the official price is disconnected from reality. Listen to what the gap is saying, because the gap is the truth, speaking in a market that would prefer to maintain its comfortable illusions. And truth has a way of asserting itself eventually, and violently if necessary, when illusions are maintained for too long. Thanks for watching. Don't forget to like this video and subscribe for more updates as this story unfolds.